Hello, you're watching Dukascopy TV. I'm Natalie MacDonald. In the studio with me now to discuss investment prospects for 2014 is François Nordhof, First Vice President of BCP. François, thank you very much for coming in today.
Hello, Natalie.
Okay, so talk us through the investment year so far in your eyes. What have been the big moves?
Well, the big move is indeed the surprising performance of the equities, where at the beginning of the current year, everybody was expecting fixed income to outperform equities, and in reality, at the end of the exercise, it's completely different. Equities outperformed fixed income, and you have even some segments of the fixed income industry which is returning negative return for the full year, which was for some investors indeed a little bit a disappointment.
Looking ahead then to 2014, do you think that US Fed tapering, expected to be one of the big stories of next year, could result in a repetition of the summer sell-off we saw in emerging markets, or is there potential for a rebound there? For example, investment in Brazil is already picking up somewhat.
Yeah, well, exactly. I mean, tapering will return to the table, that's for sure. It will come back as a subject, as a critical matter, as soon as we are discussing budget issues in the US and the problem of reforms also in the US and also in other parts of the world. Therefore, those issues are coming back to the table. This is again going to limit the appreciation potential of fixed income asset class, mostly what we call the sovereign bonds and what we call the investment grade bonds. High yielding and emerging bonds are something different, but at least in the conventional fixed income asset classes, investors for 2014 should not expect any positive return. That's for sure.
Given BCP's euro area inflation forecast, in your view, what could the ECB, well, what could and what should the ECB be doing to fight deflation? And similarly, what impact are you expecting for bonds and equities?
Yeah, well, at first I would say the ECB is actually very linked to the Fed. They are, indeed, it's an individual institution, they have their autonomy and all the things, but frankly speaking, they are just looking to what the Fed is doing, and they are a little bit adapting their own policy to what the US decided before. That's for sure. The ECB for the time being has a very limited leeway. They may reduce maybe the interest rates for further 50 pips, but furthermore leeway there is so far nothing to do. They can maybe, if they want to become very aggressive, make the same then in the US, which means monetary authorities will come to the market and purchase mortgage-backed securities or whatever it is, and this could indeed help a little bit the fixed income market, mostly the conventional fixed income market, but the problem is not there for the central bank, the European Central Bank. The problem is to finance the corporate sector in Europe and to give the liquidity to the corporate sector. And this cannot be done only with interest rates policy, for sure not.
So if we consider then how clients should be investing, how is next year's portfolio balancing up? Where are you going to be overweighted and where will you be advising clients to remain underweight?
Actually, there is an euphoria. Clearly, investors are euphoric currently. We are in a bull market. All indicators, sentiment indicators, technical indicators are really bullish, and nobody believes in a market correction. I mean, you know, it's exactly the moment where you should, as a clever investor, be a little bit contrarian and look to say, okay, be careful, every news is more or less good, or maybe even bad news are trying to be interpreted as being a good news. Have a look to what happened, for instance, to the earnings forecasts. Everybody is forecasting, like every year at year end, a double-digit earnings growth on most developed markets, also on emerging equity markets. and everybody is expecting, therefore, equity market to run. Frankly speaking, if from now on up to the year end, the equity market is appreciating in the US, in Europe, by 5 to 10%, the appreciation potential for 2014 is going to be very, very, very limited. And unfortunately, most of investors make abstraction of 2013, saying, okay, it's finished, it's done, and there are still 6 weeks to go. Christmas rally, okay, is going to happen anyway. Therefore, let's just focus on 2014. But 2014, when you have top profitability margin and no additional liquidity coming to the market, it's going to be very difficult to expect another expansion of valuation multiples on the equity investment side. Therefore, I would say, if you would purely speak from a risk point of view, you should, in a balanced portfolio, having more or less 4 asset classes, means cash, fixed income, equities, and alternative investments like real estate, hedge funds, and so probably on the equity side, you should be focusing between 15 and 20% of equities, not more. And on the fixed income, you should not be invest or exposed to, as I said, long duration sovereign bonds of developed economies. You should also focus mostly to high-yielding corporate bonds and emerging debt. That's where you should be focusing. Even if we are aware about it, the nice days of the emerging bond market is probably behind us in terms of sovereign debt. But there is not only sovereign debt in emerging market, you have also corporate debts. And this is probably for most institutional clients and also private clients something new. So let's allocate quite a big part of your investments also to fixed income, emerging corporate debt. You will be probably positively surprised. At least you can carry the yield over the year, which is something very nice in a bull market like the one that we have just right now. In terms of cash, indeed, you need cash, because if you want to be opportunistic, you need to have cash in your portfolio in order to be able to react to any market correction. And alternative investments, I would say, do not stay away of real estate, be invest in real estate. That's for sure a good opportunity, also in terms of carrying yields for your portfolio. And then in commodities, I would be less negative than most actors in the market. I would say you need an exposure to commodities, probably not gold, because gold was clearly digesting and is currently digesting a bubble, but there are other commodities in the market, and in the long run, commodities have always been a good bet against inflation. Even if we were speaking about deflation, doesn't matter. I prefer to lose a little bit of performance, but being exposed to commodity than to make abstraction of commodities and to hope to make a further profit. Then the last segment of the alternative investments is indeed the hedge fund industry. I'm pretty sure the hedge fund industry is recovering from previous corrections. The big disaster in 2009 has been now digested. Now it's to a certain extent a different, not a new industry, but a different industry, which is, I would not say not more cautious, but maybe more aware about the individual risks that they were taking. And therefore, I would say this is also a pocket, an investment pocket, which should be exposed, where your portfolio should be exposed to.
François, some really interesting comments there. Thank you so much for taking the time to come in and share them with us. Thank you very much. We'll be back shortly with more exclusive interviews for you, but for now, it's goodbye from me.